So this is a very simple logic. You can't keep borrowing money endlessly. Issuing trillions of bonds to push interest rates down is not a strategy. It's simply desperation. And here's how ridiculous things have gotten in Japan. For the majority of 0 to 10-year bonds, their central bank is holding over 50% of all outstanding debt. In total, the Bank of Japan owns nearly 600 trillion yen in Japanese government bonds, and that's $4 trillion spent to suppress interest rates. Half of the entire market is in a twilight zone. The issue with financial engineering is that it never works long term. Yes, you can suppress rates, but it will come at the expense of the currency. And finally, the BOJ is admitting the collapsing yen is a problem. Their new currency chief just made a painful admission, which is a big deal for a central banker. The demerits of the yen depreciation are becoming more noticeable. He can no longer ignore the real crisis Japan is facing, which is the destruction of their consumer base. People simply can't afford to spend money and they are cutting back everywhere. This chart tells us the effects of a collapsing currency. Nominal wages in black are up with increases of 1 to 3% on average. And that looks good. People seem to be earning more, but real earnings in blue are negative. So if you're a salaryman in Japan, you are losing buying power every single month. You're not motivated to spend and consume. And because of the yen falling, critical imports are flying to the moon as well. Your money is channeled towards food and utilities, the basic necessities. The argument for weaker yen used to be for export, that a weaker currency is good to sell to the world, but is that really the case? Let's not forget Japan isn't rich in natural resources. They don't have vast stores of mineral wealth like China or Russia. Energy has to be imported as well as all the metals like steel and copper. And the latest data tells us a weaker yen is crippling Japan's industries. Factory output in June has crashed once again by 3.6%. And this is a big drop considering the yen dropped by a lot during the same month. This is evidence that a weaker currency doesn't necessarily make your exports more competitive. It is not a causation. You aren't building out better supply chains, you aren't lowering the cost of production. A collapsing yen just makes your intermediate goods more expensive. Just ask Toyota, Japan's biggest automaker, is falling hard. Global output has dropped by 13% in June, down for fifth straight month, 5 months in a row. And clearly, the weaker yen isn't helping exports fly to the moon. There are more important considerations like supply chains. Because of this realization, the BOJ has signaled that they are going to pivot. They have run out of options and we are heading towards more interventions. Despite having a mountain of debt, Japan is taking on a big gamble. They have officially hiked interest rates to 0.25%. It is the second hike since 2007. In addition to this, the BOJ will scale back their bond purchases by March 2026 to just 3 trillion. That's a 50% drop from the current levels. And this is rather symbolic. Japan just surrendered to higher inflation. They admitted defeat. They can't wait out the Federal Reserve any longer. But will this reverse the yen collapse completely? Probably not, because there are other fundamentals at play. You have the Federal Reserve refusing to cut the Fed funds rate. The differential is still too high, it's over 5%. And let's not forget Japan's enormous balance sheet. It's nearly 5 times bigger than in 2013, from 170 trillion yen to 760 trillion. Interest rates can't go up sharply without imploding the balance sheet. Remember, by 2026, they are still buying 3 trillion yen a month. This means the big yen reversal isn't guaranteed yet. Japan's new currency chief made a statement, something that we knew all along. The only solution to save the Japanese yen is to improve the economy. Financial engineering can only get you so far, but this will take years or even maybe a decade. China is outcompeting Japan, and the US is reshoring industry and about to raise trade barriers. A trade war is coming. So the Japanese recovery isn't going to happen anytime soon. So from now until then, we can expect Japan to keep dumping US dollars to prop things up. Since September 2022, Japan has intervened in the currency markets at least 4 times. In March this year, they did their first rate hike, but the yen kept falling against the US dollar. There's really no reason to believe the recent rally is a big reversal. Till then, we'll see the BOJ burn 50, 60, $70 billion more to support the currency. The Fed still has to cut rates down for a lasting change, but when that happens, it won't be good for the US economy either, because Japanese investor money could leave the US in droves back into yen assets, and that could trigger a nasty sell-off in both the US bond market and the stock market. Now, just because Japan hikes rates doesn't mean their exports are safe. Their biggest manufacturing rival is China, and this is truly a zero-sum game. Just think about it, especially when it comes to cars. Most households around the world can only afford one vehicle at most. So if they aren't buying a Japanese brand, chances are they are buying a Chinese car. And this manufacturing war is playing out in Thailand. The New York Times sums it up perfectly. Japan built Thailand's car industry. China is gunning for it. Countries in Southeast Asia used to be dominated by Japan. Brands like Nissan, Mazda, and Honda, they are all household names. But China is one step closer towards devouring the Thai auto market. They are grabbing market share away from Japan. And this is very serious. Japan's big head start is going to vanish over the next 5 or 10 years. Japan today still has a monopoly in the Thai car market. In 2022, 85% of vehicles sold were from a Japanese brand. But in 2023, this has dropped to just 76% in just 1 year, 12 months. At the same time, Chinese brands grew their presence from 4.7% to 10.3%, more than doubling their car sales. And it all has to do with the rise of electric vehicles. It's really important to understand the speed of Chinese automakers. When they see a market opportunity, they go full steam ahead. And this is something Japan or Germany for that matter isn't accustomed to. Just listen to this story. It's truly remarkable at the speed China can operate at. GAC Aeon is an EV automaker from China, and when they came to Thailand, they didn't even have a clue. This story is really crazy. They had no office, no factory, and no employees. They set up shop in a hotel and they worked in conference rooms and they held meetings in the lobby. They worked around the clock recruiting local dealers. And within 74 days, which is around 2.5 months after arriving in Thailand, they sold their first electric vehicle in the country. And this isn't the exception, it's the norm in Chinese companies. It's shocking when you hear from Japanese brands fighting against China themselves. And this is from the chief of Sony Honda's joint venture, a company producing electric vehicles. Japanese car makers are very scared by China's rapid EV development. Japan's conservative corporate culture simply can't keep up, they are moving too slow. And here's the death knell: the development time of Chinese EVs from conception to production has shrunk to as little as 18 months. So Chinese automakers can produce a new EV model in half the time versus their rivals in Japan. There's simply no way to compete at this rate. While it's true that Chinese EVs can't enter the US and Japanese exports can, it's quite meaningless when it comes to the global market. Japanese automakers can't hide behind a wall of tariffs. It will just destroy their competitiveness. They'll be completely beholden to the US economy and the consumer market as well. In December last year, the Thai Prime Minister reminded Japan to wake up, please wake up, to make quicker decisions on whether to make EVs in Thailand or not. You are not alone in the world, and that was the warning. Obviously, Japan didn't take it seriously. While China moved in, they swooped in and they ate their lunch, and it's going to be a very big meal. Chinese EV players already have a foothold in Thailand. BYD, for example, is producing 150,000 cars a year. GAC Aeon produces 50,000 vehicles now. And in total, we have nearly 800,000 units being rolled out annually, mostly for the local Thai market. And this number will only continue to grow. So why did China move into Thailand in a big way? The EU tariffs didn't really come until a few months back, and it's quite simple. The Thai government is pushing to go green, which includes their auto market. By 2030, 30% of cars produced in the country will be zero emission vehicles, in other words, EVs. And this also includes the domestic manufacturing of batteries. So you have a country looking to transition towards electric cars, and demand is going to go from zero all the way to the moon. And it gets better. To encourage EV adoption, Thailand is also giving out tons of subsidies to lower costs. For EVs made in the country, buyers can get up to 100,000 baht per car until 2027, and that's nearly 3,000 US dollars. The BYD 803 in Thailand is less than 900,000 baht, so you're handing people a rebate of over 10% off the sticker price. And this is going to drive adoption up and make EVs even cheaper than some combustion cars. It's a no-brainer that ICE vehicles will drop in demand over the next few years, at least in Thailand. And because Japan is lagging behind, some automakers like Suzuki, they are closing down their plants. And this is really sad. The Suzuki plant started production in 2012, and they were producing ICE vehicles for the local Thai market and for exports. So the company had their ear on the ground. They knew the EV market was going to explode, but they just didn't pivot fast enough. And this is playing out across Japanese brands. Big names like Honda are also scaling back production and trying to make the shift towards EVs. But can they pivot? Now, sure, definitely they can, but it's going to cost a ton of money building the supply chains and just reconfiguring the existing factories. Thailand gave Chinese manufacturers a fantastic deal, a $4,000 grant per EV made in the country. And by the time the Japanese automakers make the shift, will the subsidies still be around? Chances are no. Japan faces a ton of problems today. Their currency collapse and losing the EV market are just symptoms of a bigger crisis. They are avoiding reality, the bigger picture, and trying to use financial engineering as a solution. However, they are in a bind, and here's where the doom loop comes. Strengthening the yen is necessary, or local consumers will be destroyed. But if they do it, it will hurt their own exports. Japan can always manufacture in China, not a problem. Japanese companies, they have a ton of factories there, but will only deindustrialize the country even further. So, of all the G7 countries, Japan might be in the worst spot, and it's going to get far worse before things get better. But as always, let me know what you think. Will Japan's rate hike change anything? And can they pivot and compete against Chinese EVs? Let me know in the comments below. Stay safe. Be sure to smash the like button and subscribe as we navigate through these crazy times.